Do you see this sell-off that we saw on Wall Street this week and the big backup in Treasury yields that preempted it as a result of what the Fed is doing and the shift in tone that we got from Powell at the last meeting or a speech after that?
Yes. Trump is right that this is the Fed's fault, but he's wrong to say that there's something wrong with that. In fact, all that's happening is that we are exiting a period of around 8 or 9 years when growth and inflation were always disappointing. We had like one shock to the economy after another, whether it was Brexit, the collapse in oil prices, and the Fed was always biased to being easier rather than tighter, to a world now where the risks are two-sided and there are, equal probabilities that the Fed goes faster rather than slower. Bond investors have been slow to basically catch up with that. The rhetoric from the Fed, whether it was Charlie Evans today or Jay Powell last week, makes it clear that those risks are two-sided, that we're in a normal world that requires normal interest rates. Bond investors are adjusting, and it's just natural that stock investors have to adjust as well.
Professor Barnett, we have this debate raging, and the words that we throw around are neutral, normal. How are we going to define those words before we can decide whether, in fact, we should go past neutral?
In the field of economics, that's an ambiguous term. Neutral would be the marginal product of capital, which varies over time. I find it difficult to believe that interests at the present time are above the marginal product of capital. So I don't see a problem.
Okay, so you don't see a problem yet, but is this a legitimate question as to whether the Fed, in fact, should be determined to raise interest rates a few more times through next year?
I'm in favor of what the Fed is doing. As you know, I'm author of the book Getting It Wrong, which is a criticism of the Federal Reserve. And I don't hesitate to criticize the Federal Reserve when I believe criticism is warranted. But in this case, I believe the Fed is getting it right.
Evan?
Greg, it's Evan. I had a question for you regarding the shape of the yield curve. You've covered the Fed for God knows how many years. When they look at a yield curve that's as flat as this, and they talk amongst each other, what do they say to each other? It doesn't matter, or do they say, oh, it does matter a lot? Or because it is pretty flat right now, given the current projections for economic growth.
Look, they look at the yield curve, and more precisely the long-term bond yield, as essentially, what is it telling us? What are all the investors out there in their collective wisdom trying to tell us about the world that we might be missing? And I think in a world where they're raising rates, but the bond market is saying we don't think that's necessary and bond yields are low or going down, that's got to be worrisome. It's kind of, it forces them to sort of check their math and look over their shoulders. And so, we had, Evan, you were following this debate as closely as I was. There was a lot of hand-wringing over the last 6 months that the flattening of the yield curve was a harbinger of a recession. I personally never bought that story, but there's certainly a long history of flattening yield curves preceding recessions. So what I find a little puzzling now is that the yield curve has started to steepen in a rather dramatic way, and people they're now worried as well. They're now saying, oh dear, the long-term rates are going up, it's steepening, that's terrible. Well, you can't have it both ways. So in some ways, I kind of feel the fact that we're seeing this bear steepener of the yield curve with long rates going up faster than short rates, kind of comforting, because it tells me that bond yields are going back to a world that sort of feels normal. To tell you the truth, 3.25% still feels abnormally low to me, but not as abnormally low as 2.5% was, which is where we were in August. So I personally have trouble getting too excited or too worried about what we're seeing in the bond market now.
So, William, there's a lot of Fed debates out there right now, and some of them we were just talking about, but there's this other idea that some are saying that one of the sources of the market angst this week has been people worried that the Fed is just sort of on autopilot here, determined to raise rates again once this year and then 3 more times next year, and they want to get back to normal, and they see the economy as looking very healthy and very strong, which the numbers back up. But there are pockets of weakness, and Cramer's been really big on this theme. If you look at housing or autos or liner boards, and there's a question as to whether the Fed is missing some anecdotal or pockets of weakness out there in the economy, and they're going to be raising rates at a time where the economy is actually decelerating. Do you buy that argument?
In my opinion, the worst thing that could happen at the present stage of the expansion would be reappearance of extreme exuberance, what happened prior to the financial crisis. What's happening at the present time in the stock market basically indicates that people recognize that there are risks. You've mentioned some of these risks. There are a number of such reasons to be concerned. The fact that the stock market is adjusting to it is good. I view all of this as positive.
Sarah, if I could jump in just for a minute, I think I would respectfully disagree with William on that one. I actually would align myself with what Jim was saying earlier today. When you actually look at the internals of the stock market, there are a little telltale signs in there that you might want to worry about. The sectors that have been underperforming are like banks, small caps, transports. These are sort of the cyclically sensitive sectors, which are usually kind of the canary in the coal mine when the economy is slowing down. Even though I don't believe a recession is coming, if you sort of just basically look at the mathematics of the huge boost, the huge stimulus we got this year from the tax cut and the federal spending boost, that starts to ebb away pretty quickly over the next 12 to 24 months. And I think the nightmare scenario is you have a situation where the Fed in some sense is head faked into thinking that we're developing this inflationary head of steam, and suddenly, just because of that arithmetic, growth suddenly decelerates sharply just as the Fed is over-tightening. And that would be an ugly situation to be in.
So is the Fed missing something, Greg? Is that what you're saying?
I don't think they're missing something. They're very well aware of the factors we're just discussing about right now. But it's a balancing act. You know, if you listen to them, I don't think they would have chosen now as a time to pour $1.5 trillion of discretionary fiscal stimulus into the economy, not with an unemployment rate at a 49-year low.